Good morning, everybody. Oh, how's everyone doing? Should probably put a link to this in the Discord. Happy birthday, Guac. Let's settle in for 2 hours of confirming my short-term marriage bias. I'll do my best. Thanks, Cowboy. Thanks, guys. Oh, is the Diamond of Doom ready to explode? Oh, it's just bullshit, right? It's more interesting because diamond, like actual diamond tops, are pretty rare. But yeah, it's just nonsense. Could you give a shout out to my son Diego, whose birthday is today? Hello, fellow birthday person. Happy birthday, Diego. Diamond top equals full port yes contracts. Diamond tops are actually a thing. Yeah, yeah, they are. There's one on ES right now. Thanks, Cyborg. Little G Wagon, welcome back to Dillionaire, man. I appreciate it. Hit me up on the Discord if you need me to get you re-added, but you should be good. Happy fucking birthday, you stock out chill. Thanks, Lawrence of Arabia. I appreciate it, man. Holy fuck, I'm hungover. I mostly wanted to hear tales of what happened this weekend. Well, I went out last night, and for various reasons, I ended up in a seedy check cashing establishment. Um, that was weird. And then I'd like pick up like an international wire transfer. Anyway, that didn't work. And then I went I went like down the block to meet my buddy at this hotel, and we went over to the like lounge area, and he ordered some like appetizers, and then immediately started popping copious amounts of Molly. Him and his buddy. Um, the rest of it's just I don't want to get into it. I was supposed to ditch them last night, Dork. That was my plan. Is I was gonna tolerate like the birthday partying thing for like an hour or two, and then like quietly Irish goodbye them. It was rough. Molly before Appy's rookie move. It was definitely a rookie move. No, I didn't do any Molly. Those days are behind me. Did the wire transfer come from a prince in Nigeria? No. Prime Minister of Kenya. The parts you don't want to get into are the parts we're here for. I don't remember a lot past, I don't know, 1 a.m. I at some point I decided that I was gonna keep pace with how fucked up they were by drinking as much as possible, so I wouldn't be responsible for babysitting them. It may not have been a great choice. Uh, uh. The world needs to know, did you or did you not hook up with Snooki from Jersey Shore last night? I hooked up with a couple of people, but none of them were Snooki. Snooki wants smush smush. Oh, fuck you, Lawrence. Have you ordered your saline bag service yet? They're very busy today. I checked and like the earliest appointment was 5, at which point I won't be hungover anymore. This is the worst I've been hungover in a while. I fucking need some sunglasses or something. I'm gonna see if I have any sunglasses in my room. I'll be right back. Off. Oh. All right, I'm back. I don't have sunglasses. Oh. Have you considered getting your own IV service franchise? No. I'm impressed you've made it. Happy birthday, man. Thanks, dude. Just keep drinking. I'm trying that right now. It's not working. Thanks and happy birthdays you received today. I hope it sticks just how much we appreciate you and all you do to entertain and help us regarded Dans. Happy birthday, Daddy Pickle. Thank you for all that you do. Thank you, Jay. I appreciate it, man. Pedialyte or pickle juice. I don't have those things handy. Thank you, guys. Oh. Is it difficult to make your way around all the passed out hookers sprawled across your floor? There's no hookers in my apartment. There was. I don't think there were any hookers. Well, maybe there were. This is super important. You need to read it. Happy birthday, you beautiful Persian centaur. Thanks, man. All right, let's talk stocks and markets so I can go back to sleep. No one was in my apartment. I got home at 7 a.m. Tom, thank you so much, man. No membership for the poor. Thanks for all your teachings. Made shit tons of money because of you. Thanks, Pickle. Here's some more profits and less losses for all eternity. Tom, first of your name, first of your caliber. I appreciate it, man. Thank you so much. Oh, that almost made me throw up. Okay, no cooing. It immediately triggered my gag reflex. Oh, that was bad. Oh, don't write herb. All right. Lost tons of money thanks to you. Happy birthday. You lost tons of money thanks to yourself, bipolar bear. Don't blame me for your stupidity. You fucking bought GME at $23. Now you're an Uber driver. $24? That's even worse. How many times did you karaoke both Alicia Keys and Jay-Z parts of Empire State of Mind last night? I didn't. We did go to a karaoke place, which I think is where the hookers came from. And then the only song I remember singing was Total Eclipse of the Heart. Nope. Nope. Meatloaf, too. Yep. It's the same haircut under the hat. Oh, my skin's itchy everywhere. Windmill Willie 2021 most improved trader. There was a midget, some squirrels, a 5-gallon bucket of mayonnaise. I don't want to get into it. Well, happy birthday, brother. Thank you so much, Willie. No, it was super it was really surreal and weird. It was like this place that was behind like a fucking laundromat in a deli, and then you go in and there was like a bouncer, and you go into this like warehouse space that's divided into like karaoke rooms, and then we got one, and all these like Eastern European women showed up in the room. I don't know who the fuck they were, but I suppose that's like part of what happens there. I know that I bought a bottle of Grey Goose for $580 worth. Bonnie Tyler's a bold choice for a man in his 30s. No, it's not. Eminem's a bold choice for a man in his 30s. Thanks, La Flama Blanca. Let's let Girk talk stocks. He can sleep more. I think we call them strong, independent women now. Okay. If you weren't singing the Michael McDonald version of Regulate, you ain't living. I didn't. You might be right. That's only an 800% markup. Yeah, it wasn't bad, although I'm not sure why I paid for it. Grey Goose, this is where my membership fees are going. No, your membership fees go into an account that I've not checked in 5 months. Zom bounce to 113 or fall back to the 100 105 range. Okay, yeah, it's kind of hard to look at the charts right now, but I'll do my best. So oil's interesting. There's an OPEC meeting this week, and they're expected to cut production more, or more countries are expected to pile in to production cuts. There's also some rumors that Venezuela's preparing to cut production as well, which could be very impactful. I would watch the like 106, I guess the 106 through 107.50 level. That can be pretty important. Also, dollar value dropping. Dixie's at 103.80. If the dollar continues to slide and we see more unwinding in the JPY carry trade, that could spike oil prices as well. So the combination of those two things seem to have led oil to bounce back pretty hard on Friday. I don't know if it's going to continue. I'm sure the OPEC decision will be a big part of it. Also, watch out for S&P. There's a lot of shorts on Zom right now, though. I think more than any other company in the S&P right currently. So they could get squeezed, especially if OPEC's cuts, right? That was my question as well. It was your birthday outing, cheap friends. I think they paid for everything else, but somehow I did end up buying that. Is this a true diamond top? Aren't the two resistance tests supposed to be more uniform? To the same legit question. Okay, so we could discuss that. They are fairly uniform, right? The high test is, well, actually lower, which is more bearish, but no, that's way too thick. Hold on. Yeah, so the high tests like there And then the low test is there, right? It's pretty textbook. So Airbnb CEO cashed out with half his shares and got a downgrade. All right. We could take a look at Airbnb. I've been out of it for a little bit, but I'll check it out. Um Oh, that bounce really played out well. All right. That could be a good entry for back under 116 again. I kind of like it. Let me check out the options data on it real quick. A long time ago, I'd back tested them. I mean, on indexes, they're really rare. There's not a lot of them to test, and yeah, they usually fail. It's like the high 80%. On individual stocks, they occur more often, but they also fail there. Let's see. So Airbnb dealer Delta fell off on Friday. Gamma fell back to negative. Charms negative, and total bought call Delta fell off. It's sitting right on top of Delta Gamma and the charm flip. So yeah, if it loses 125, it looks like it's gonna come down pretty hard. Yeah, I'll probably write that one up tonight. That looks good. Nvidia. So I'm still sitting on fucking 480 spreads on Nvidia. The like debit call spreads that I can't close. I'm kind of hoping it comes down a little bit this week after the lower high. But earnings is Tuesday, right? Or Wednesday? Tuesday. So it may just hold, right? It may not lose 490. So yeah, I mean, yeah, it may not come down until post earnings. I will say that it's pumped up enough at this point that if they don't just kick ass at earnings, all the speculation on earnings is just going to get chewed up by the market maker like last time. That was like back here when it spiked like overnight and then it opened at the same price. And then the market's maker spent an entire day just eating up everyone's theta. So watch out for that. I probably wouldn't play earnings on it. It's really risky. Thanks, Yaga. It was interesting. These guys even your friends? I know we're probably not much better, but I'd at least get you a bottle of scotch for free at my parents' bar, dog. Thanks, man. Glonk went down. We'll discuss that. Thank you, Breton. Well, IWM continued down. So yeah, IWM bounced back above delta neutral. It's still below. It's still below my risk level. Besides that one kind of crazy wick. The biggest problem with IWM is it's kind of floating in between short squeezing even more and failing, right? And we got a little failure on the initial entry, and then like Friday, Delta and Gamma bounced back a little bit, but then Charm collapsed. So I think part of the bounce in IWM on Friday was just like the supportive flows, and it's still likely to pull back to like that 174, 175 level. Now that the charm has fallen off from the OPEX expiry. I think charm on it went from 783 million to 105. So that's kind of a lot of exposure falling off, and Gamma and Delta went up, but Delta's still negative. Gamma only went up like 500 million. And those short dated options will expire too, right? I don't want to further trigger your gag reflex, but can you touch on GME? Is there any chance to go up later in the week? Hold on, let me check something. XRT is still on reg show as of Friday. So that's obviously not a good look. I will say that there's covering going on. Very little, but we've been getting a slight bit of covering over the last since like the 13th. Obviously it hasn't broken out or anything, but it's been ongoing. The technical setup looks really good for a bounce. The tips are starting to converge, but they haven't crossed. XRT is still on reg show, which is obviously a problem, but I would say it looks slightly better. The covering we're seeing here is a little bit faster than we saw it back in August, when we went from like 16 to and peaked at like 21. Earnings are in a couple weeks, I think. I don't know if we have a fixed date yet for those, but they should be coming up. I would imagine they'd want XRT off reg show before earnings. So yeah, it looks okay. I wouldn't say it's a guarantee, but it might be worth a small amount of exposure. Doesn't the OpenAI nonsense? I think it's significant enough to actually move Microsoft. Given the effect it had into close, it seems significant either way. Well, so actually talked to my friends about this yesterday. Apparently there's like a lot of rumors swirling around that like Altman wasn't honest with like a lot of their VC backing. Um and the pressures of that were alleviated by Microsoft's buy-in, but basically the board doesn't think he's capable of running the company at a higher level. Anyway, I know that like there's some shit going on with like Microsoft wants him back in, and then the workers are gonna strike and the president quit, and it's a whole big shit show, which is usually awesome for bearishness. Uncertainty is the best. I haven't talked about SPX yet, but I'll go into that with Dork and J Fresh. Usually I save that for the end. What are you going on about, de-engineer? Fucking autistic questions. General question about OI charts you post and Pickles picks every morning. Those are gamma charts. Those aren't OI. How do we interpret that? I usually write up like a little guide for you to interpret them. It doesn't really tell you how to identify a play. It kind of just tells you a little bit about where positioning is and how it's structured, where it's weak, where it's strong, where positioning needs, like there's information in the negative space where positioning needs to be in order for moves to be made one direction or the other. ETFs can't squeeze. They can just IOU any shares needed, then CNS, then make good later. Yes, yeah, you're correct. I mean, a move on Jimmy would have nothing to do with XRT squeezing, right? It would have to do with cash settlement and the ETF buying in. So Altman fired, then board fired, then Altman rehired. What do? It's, I mean, that's gonna raise a lot of doubt, right? No matter what, it's gonna create some doubt. Even if it shakes out with Altman back in charge, right? There's still gonna be questions about why the board kicked him in the first place. Like I think it was more than just a simple like power grab. How do you anticipate June to rise on GME as we approach earnings? I mean, it may if people buy fucking options on it, but yeah, they usually don't, right? It's been a while. That might add a little bit of confidence. GME's almost delta positive on the dealer exposure side for the first time since September. So there may be a little bit of interest, but there's less overall interest. Like Gamma's significantly lower than it was back then. Charm's negative as of Friday. Bot calls outs I fell a little bit, so GM's at 1628 right now. I mean, it may move up a little bit, but don't forget that you could like GME can exceed Gamma Max, right? It is illiquid enough to pull that off, at least briefly. And so, you know, in the past, you've seen it clear Gamma Max by, 10, 15% before ultimately failing. I'm here. What's up, Carl? Congrats on completing another lap around the sun. I appreciate it, man. I mean, I don't think they know anything that nobody else knows, right? I mean, they're both idiots, especially when it comes to this kind of stuff. But they do work in professional finance, so they may hear different rumors than we hear on Twitter. But the rumors are equally like they're not better rumors; they're also just bullshit. Jitsi Poo, hey man, thanks, dude. It's almost like AI is turning into a big money grubbing Ponzi scheme or something. Thanks, Nuke. Were one of those karaoke girls Carl's wife? No, no, no. She's much higher class than that. Where do you see HE going? It's pushing 14. Will this drop it down to the $12 range? No, I mean I think the broad like short position positioning in utilities has been backing off a bit over the last month or so. So if we go, let's look at the utility sector, and then kind of let's go over. Yeah, so if we look at the utilities performance over the last month since we started bouncing, it seems to be that a lot of the short interest in like broad utilities is clearing, right? And so obviously that benefits HE to some degree. However, the HE specific short position isn't really going anywhere. So, I mean, and that's probably not going to be resolved until I would say at least until some of the lawsuit shit is figured out. They're probably not going to walk away. So, yeah, I mean, I guess if the market falls, there's a chance, but that kind of like defensive pickup that we're seeing over on this run with the broader breadth could be an indication that participants are they want exposure to equities, but they're a little more wary, and so they're focusing on like commercial services, producer manufacturing, transportation, and industrial communication utilities, right? And so and maybe a little less focus on tech from individual investors, right? And so that might be kind of like a tentative uh exposure coming in if the markets were to and the economy were to look sufficiently worse. um Utilities is usually a very attractive sector as like a defensive. What are your thoughts on gold action lately? um so I got in a little bit on the dip, not a lot. I closed out of my prior long gold position when we ran, like when it ran hard a few weeks ago. I'm kind of hoping that it gets back under 19, but it might not. There's still a lot of currency worries, and it's possible that with the dollar retreating more, gold might move higher. There's definitely more concern with like broadly with the USD JPY trade, especially with Japan's decision on the 18th. If the carry trade collapses at any point, gold will be a beneficiary. Thanks, Jim. So unless we do significant damage this week and Nvidia doesn't tank the market, the charm flows from December to Jan can keep us afloat a while longer. Well, charm on those options really shouldn't be very significant, right? There's like the end of November expiry, which will have like some positive charm, but it's not very much. So most of that should collapse until we approach the bigger expirations like December. So charms far more important when we near an expiration than it is further out from one. Thanks, Havercrow. How was your little account doing? I remember you were doing a lot of vertical spreads on SPX. Um, Not so hot right now. I'm a little over leveraged the short side in it. If it drops, it'll be doing better, but not great. Close to blowing it up. Although it did last a long time with $1,000. Well, I've got till Thursday, so we'll see. if the current spreads hit by Thursday, I make like 12K, 8K, 12K or 8K, something like that. Like the stream for birthday wishes for our fearless not a cult leader. Thank you, already. Yeah, if you guys could drop a like, it's a big help. One of us. It's hard to make $1,000 account survive because you can only really be wrong twice, maybe, or you have to take almost no leverage on anything, and I don't have the patience for that. Um, let's see. I guess we could run through some other shit. Upstart looks like it's being actively shorted while it moves up. So I would expect that once indexes move down or Nvidia is no longer driving insane pressure on bots, uh, that Upstart will start to fall. They're building up a pretty substantial short position, and the sell off from earnings provided liquidity. So yeah, there's a good chance that once the covering's done, it'll just fail again, which we kind of talked about before. You know that it could, after earnings, that it could bounce back up to about 25, which it mostly did. It had like one slightly higher test, and then it can hold 25 briefly with just a slightly positive market, but if indexes fall and that ETF liquidity comes in, it's definitely going to come back down. I think they're building pretty decent short positions at 25 and 20. And then out of the money selling like the 27.50 and the 30. Fubo's a bit trickier. So there was some covering on Fubo after earnings, obviously. And that led to a little bit of liquidity being realized, and a lot of that was pressured by IWM running, like R2K having that big like 500% move. Now that that's over, or at least calmed down a bit, we've been beginning to see some, like, more short interest come in. Hold on, this is way too thick. We started to see more short interest come in here, but then Friday we started to see a little bit more covering. So right now it's not super illiquid, it's not like it's in this kind of positioning, right? But it's moderately illiquid. And it could really go either way. I mean, the fact that it closed Friday above $3 obviously is to its benefit, but this is kind of another one where I would say that it's liquid enough that it needs index support to keep running, but illiquid enough that I wouldn't risk deep in the money covered calls. I've sold like threes a couple times through here, and I've been able to pull them back, but I haven't sold any like 250s. Siri, so Siri kind of looks like it might be breaking out. I know Buffett picked up a stake in it, and that put a little bit of pressure on it in the early part of this week, and then that's kind of ground down into the end of the week. But it's held $5. $5 is really important. It's like the big flip point on the chain between the massive put positions and the calls. If the MM is forced to re-hedge next week, then yeah, this could move up. I think the call interest there is pretty significant. Also, Siri's share lending yield is phenomenal, which I should probably point out. Macy's ran. I'm pretty much out of it. It never hits Gamma Max, and it's kind of close to there. It's got like $3 of range till Gamma Max. Maybe it'll break back up to like 15, 16, but I don't think it's gonna run a lot more than that. At most maybe like 1650. But yeah, I've sold covered calls against my position, so I have like a few upside calls in case it keeps running at $14, but I'll probably just close those also. Then we can look at Apple. I mean, Apple's kind of peaking at the prior resistance, but call interest here is still strong. It takes a really long time for call interest on Apple to break down generally. Um, Usually moves like this are rare. Usually the breakdown in call interest on Apple plays out more like this. So you usually have tons of time to confirm. They don't have any earnings or any like surprise news coming up, so I think it's safe to say that if you wanted to go short Apple, you're probably better off waiting until it breaks back down into the trend, and that's at like 182, than trying to play it from the peak, right? Because there's enough time for it to like fall and find support here and then bounce back up. So yeah, I wouldn't really consider going short Apple unless it broke back into that like long-term trend. Amazon's been doing okay, but kind of choppy. It seems to be one of the bigger losers on like Mag 7 red days, and then like a moderate winner on Mag 7 green days. Um it is moving consistently higher. Another retest of that trend might be in order. And then I would be looking for a failure, maybe back down to the 130 level. AMD's been doing pretty good. I would say that the breakout's about done here. And maybe a pullback to 110 over the next couple of weeks. Google actually still looks pretty good. I think Google might move back up into like maybe the 140 range again. I found pretty good support, and then this is carried out long enough, and the most recent bounce is pretty strong on Friday. If that fails to test the upper part of the trend, right? If this reverses next week or something and falls below the bear flag, that might be a good short down to like 129. But let me check the options on that. Yeah, about 129, maybe even like 125 on Google. Doesn't seem to be a lot of buyers up here. Call interest comes in really sporadically. Um, Gamma and Delta are still positive, but yeah, not that much charm falling off there. Let me check Google. That one's a little more stable. Yeah, that's always so weird. The difference in the liquidity on those two chains. All right, so yeah, Google looks like it might, if it fails this bounce, it might end up being a pretty good short target. Meta's still a stable coin. Microsoft. How bad was that hit last week? I haven't looked at that yet. Microsoft's probably better to stay away from until this OpenAI shit's sorted out, but so close to Gamma Max that it's possible the collapse in interest Friday could propagate a further drop. But it's going to be really exposed to all of the news, so it might just be better to stay away from it. Netflix is getting pretty close to blown out. Long-term trends being tested there. That might be an okay short opportunity coming up. And then we did NVIDIA, right? Tesla's kind of looking a little bit like shit, but it still needs to lose that 230 level to confirm. So, really not a play there yet. And even if it does, you'd be looking, here. Well, yeah, I guess 230 could maybe 230 to 221. Could be kind of that breakdown range. Like, yeah, we'll talk about charm on SJX. I gotta ask JFresh about that. 3 month, 6 month bond play is still good for less managed position for short term yearly. Yeah, I mean there's still decent yields, right? The 3 and 6 month are 5.39 and 5.418. So you're just a little bit above the effective federal funds rate. You could get higher yields, but you risk losing principal. There are like some like close-ended funds and stuff that would give you higher yields over a 3 to 6 month period, but you take on a lot of like equity risk that you may not want to. So, what are stocks do you consider wheeling right now? I don't like the macro for wheeling. Fubo's fine because it's $3, but outside of that, no. This is not a market where I want to be overexposed to cash secured puts. Short puts fine, like spreads and shit, awesome, but not cash secured. Why are Amazon Q4 2023 expectations so low? Are they? Oh, back here? Because they were pricing in like they were pricing in the pullback in 2022. Or are you talking about the next one? The next ones aren't that low. They're estimating 76 cents per share. All right, let me see what Dork and JFresh are up to. Yo, what's up, dude?
Happy birthday, buddy. How you
Thanks.
feeling?
Thanks, man. I feel like dog shit. It's okay. I'm drinking a highball right now, and it's really helping out.
Oh, good. Yeah. You know what always helps me with a hangover is a nice long shower.
I did that already.
Ah,
What I
so
haven't done
nice.
yet is sleep much. Like I
Oh,
passed out. I passed out a little bit, but I didn't sleep.
well, when you're hammered, do you really ever actually sleep?
Like a baby usually.
I don't know, man. I feel like I like you never like wake up like feeling like you got quality sleep though. Like you
Oh
wake up and you're
no,
just like,
no. Yeah, yeah. Okay. That's yeah, that's not quality sleep, but it's usually sleep.
Yeah.
I think
No,
I
it's
just I passed out at this place for like 2 hours on a couch and my neck hurts, and then I like took an Uber home and took a shower and started the stream.
damn.
Yeah.
Whew. Well, you know, I mean, could
I'm
be worse.
I'm
You'll still
running
be on
hot.
that couch.
I'm running hot.
Yeah.
I mean, yes, actually, you're right. Being on that couch would have been way worse. So all of our projections this week were garbage. Um, I came
Well, yeah.
I came closest, but mine was also shit. And then JFresh was actually closer at the end of the week because he didn't predict a market crash until Tuesday, which he's technically still locked into. Um, so
Yeah.
in order to raise his average, he's gonna have to project that we immediately bounce off 4,000 to like 4450, and then he can like improve his average over the last half of the week. So like we'll only touch 4400 per JFresh for, like 2 ticks. It'll be like that
I was
time
more.
the spy crashed back in 2022, but then like it just bounced back on the next candle. Remember that?
I do. Yeah. Just get some. Yeah. Okay. I see what's going on here. But I didn't realize we were doing like regression analysis on our predictions. I wouldn't have made such terrible predictions.
I mean, well, we haven't really figured out how we determine a winner every week. So, I mean, you could really go either way with it. There's
I
zero
think that
there's zero like methodology that we've locked in.
what we should do is we should just do like like just really cursory analysis because it's not serious. Do some really cursory analysis and then just like do like a point system where if you're right you get a point and if you're not you get a zero.
Okay.
And then I mean we could just and then have like keep a total because then we could see who was right most, and then also who had like the highest against the average or something like that.
This sounds like way too much work.
It is, but it's work that would take like a few minutes. Um, so I might do it. I might keep track. That'd be kind of fun
Okay.
because it's just like you're recording three numbers, you know.
If
I
if
guess
you
four.
if you really want to.
Yeah, yeah. I'll keep track. It'll just and you could do like such stupid like it wouldn't even be valuable.
JFresh just fell through a stack of graded papers on his rush to talk to us.
uh, it is midterm season, isn't it? Or like finals season?
I don't fucking know.
Or no, it's Thanksgiving break and then it's final season.
Yeah. That
Sorry,
depends on the school.
Yeah.
What's up?
I just got a lot going on. Can you guys hear me all right?
Yeah, yeah.
Yeah.
What's up, man? If you're busy, you
Uh,
don't have to do this shit.
no, I'm busy.
So
I think you're right.
we're digging
Gonna talk
into
about-
we're gonna start digging into SPX.
Yeah.
Oh yeah, that's fun.
That'd be a good idea.
Do you wanna inform us on how big the Mag 7 is now? Is it 30% yet?
It's still 28-ish.
Okay.
Some people are saying it's 30%, but I think they're double counting Google.
Oh, yeah, they might be.
Yeah, but still, right up there at the most concentrated ever of all time for 7 stocks. So that's good. Let's see. There's a couple of graphs I didn't put into my little rant on Twitter. If you
Okay.
haven't seen that.
I have. I read it. I read it when I was really shit faced last night.
Did you see my rule I made for you for your birthday?
No.
I was hoping that maybe you saw it. I tagged you in a quick message on the SPX thread last night that your rule was any woman that wants to make physical contact with you, you have to tell them how many shares of GME you own.
Oh God, why would I do that?
Because it'd be fun.
Oh, I hate everything about that idea.
All right, let me run this and see if I can get you some more wonderful data.
Cool. All right, Dork, you want to start with the consumer price index?
I posted a chart of that, so because I don't. I've been seeing some economics discussions online. They're starting to bifurcate between like soft landing, and hard landing.
Yeah,
And
no one can come to a
rates both going.
consensus because the recessionary measures are going to pick up as the market gets more bullish, right?
Yeah, exactly.
People are just going to start to get scared of unemployment coming up. So, because if the Fed is doing their job, it's also bearish.
Yeah, exactly. Like, I mean, so we're talking about the rate of change of CPI as if like the market gapped up 1% on CPI being flat, right, month
Yeah.
over month. So I just wanted to put that into perspective for everybody, what that looks like on this chart. So like really ultimately it's nothing like too crazy by itself,
Yeah.
but cumulatively the effects are really felt throughout the broader economy, because this is basically just a basket of goods. I know we have our reservations about what it represents, but it's a basket of goods and services, and it's the price of them, right?
Mm-hmm.
So that basket is still way above its 25-year trend. Like this move is, statistically significant. And I mean, I guess I need to plot it on a logarithmic scale to see how it really shapes out, but I feel like it's still like a 1 standard deviation move,
Okay.
or maybe even greater than 1 standard deviation, right, against the 25-year just, regression line.
Yeah.
And this, like wages haven't really grown like that. Not necessarily, right? So, I need to figure out a way to chart this versus average like weekly compensation.
Mm-hmm.
But when consumer prices flatten out, that means that the pricing power of large firms that sell lots of goods, like Procter and Gamble, those guys,
Yeah.
it's going down. So
Consumer non-durables.
yeah, exactly. So when the pricing power of large companies goes down, that's considering how pricing power has such an effect on growth, what we should be expecting right now isn't necessarily that we're done with all the economic ouchies, or that the economy is going to overheat.
We're kind of in between the two, right?
I mean,
yeah, this tells us we're entering a cycle.
Yeah.
And
the way I see it, though, I mean, from the broader perspective, we increased the money supply by 40%. The Fed has done effectively nothing to reduce that money supply at all.
Well, they've reduced supply, but they've increased velocity by raising rates, right?
No, they haven't reduced supply because the fiscal folks are spending as fast as they're tightening.
Faster.
So they have no. It's not. It's no longer faster. It's basically flat. So the Fed has done nothing to reduce the money supply effectively in circulation, and the only thing that they've really done is changed. It's hard to say that they've really done anything at all because they've made mortgages and other types of credit more expensive, but if wages and spending from the government continue unabated, then that will just get built into the churn, right? I mean, it's it's in minus out, right? If in goes up 5% and out goes up 5%, the net change is nothing, right? So I'm not convinced the Fed has actually done anything, and I'm not convinced that there's going to be a hard landing at all. I think that the only way that we can get a hard landing is if there's a credit crisis. Without a credit crisis, we still have 40% more money and an environment that hasn't been tightened, right? So we still have, and so the PCE and the nominal GDP have gone up 26%. So we still have that 14% left to go to sort of even out, this distribution. But I think it'll be a little bit worse than that because, the distribution of wealth has continued to get even worse, right? So
Yeah.
that money wasn't inputted in proportion across all income scales, right? It is dramatically weighted to the top, right? And so everyone will, unless we continue to fight for more wages to keep up with inflation that's driven by the spike in money supply. What will end up happening is that everybody will just be a little worse off, or substantially worse off, but not so much that it crushes anything. And the rich will get richer, and then once it's all absorbed, most of that excess money, or disproportionately more of that excess money, will be parked into assets, investments, speculation. And so I think that assets are going to stay elevated, until either the federal government stops spending, has so many, maintains so many deficits, or the Fed actually tightens something, or we get a credit crisis that causes disruption. But without those, I mean, I think it's pretty clear to see. I mean, for the last, ever since the ZERP started and quantitative easing back in 2008, multiples and fundamentals, all of the original analysis on companies and looking at, trying to determine what they're worth has been thrown out the window because there's more money available to throw at assets than the assets have real value to the economy in a liquid environment and a free market. And so we're just basically at the whims of all the flows of all of this money kicking around, just being active for the sake of being active, because where else is it going to go? But anyway, I mean, that in the big picture of that, I'm really not sure how much I believe in the hard landing. I mean, I think unless we get a credit crisis, right? But the Fed has already shown that if there's a credit crisis, they will come in and stop it. So
I mean, yeah, they should, right? That's a central bank's job is to try to keep things stable. That historically, they've never acted fast enough in those events. Um,
So here's my thoughts on this, Jay Fresh. And one thing you're kind of missing in your you know no landings scenario is that as interest rates stay high, and especially as there's more and more pressure on global currencies to sort of get into lockstep with their rates, um, there's going to be increased pressure on the bottom end of our economy. The bottom 40% of earners, those guys, they're really given the short end on a lot of this. I mean, their wages have gone up a bit, but more quickly has the amortization on their lines of credit gone up. Right. So that's money that's not being put into the economy in terms of spending for goods and services. That's money that's being siphoned off to interest rates. Right. And
yeah,
that's what's having
I
real drag
disagree
on
with
real
that.
growth.
And that's what I said, right? I mean, the net effect of this is going to be that without a credit crisis that cannot be contained, I think obviously things will slow down as we finish absorbing this impulse, right? I mean, at the very least, we're not adding more M2, which is substantial, right? I mean, usually we're expanding the money supply. Right now, M2 has been roughly flat for most of the year. So we're not adding M2, and the velocity is increasing as we continue to churn through that 40% of the money and kind of get it worked through to where it's going to go. But like I said, I mean, I agree with you. I think most of that money disproportionately is going to end up at the top, and already has, right? And I think that will just, as we're churning through this last 14%, I think that will continue to accelerate. And so at the end of all of that, we'll end up with an economy roughly similar to what we had before we put in 40% of the money, but with the lower end being measurably poorer or worse off. And that will all be hidden in the CPI data that you showed, right? Because PCE and nominal GDP have gone up 26%, but CPI has only gone up 19, which is a nice fancy way of saying it's not inflation, it's productivity, so we're all good, right?
Well, yeah, that was the only way to make things balance out after so many people left the workforce during the pandemic.
Anyway, yeah, I've been thinking a lot about this week, and listened to a couple folks, give their perspectives on it, and it really rung true to me. I mean, I think we have to start questioning what the real levers are when all the Fed members this last week, since they've all been talking, there's like 20 of them a week. They all say we don't understand why unemployment didn't go down. When
Up.
that enough it should be enough to show you that their theory of how things operate and what their effect is on the economy is wrong. And they can keep saying that it's a lag, but that'll only get them so far, right? At some point we have to say it's not a lag. Your theory of what should be happening is simply wrong.
It's just a lack of correlation, yeah. I mean, like you can do sort of like time delay correlation charts to find some, stuff in the reaction function, but I mean, our data set is really limited for, these sorts of tightening cycles. So it's like really hard to even come up with a correlation that matches all periods, right? So
But I don't know that we necessarily. So here's the thing, right? I mean, what happens in the past is that a credit event kind of puts a stop to the activity of the Fed, right? So they raise rates and then they hold them, and then something breaks and then they release it. But now we're at a point where if something's not going to break, or if we are able to react quickly enough to prevent anything from becoming systemic, then are they actually doing anything, right? I think the only thing the Fed is good at doing with the tools that they have is cause a credit event. But if they're not going to allow the credit event to play out, then I don't think they're really doing anything.
yeah, and that's definitely what their intention was. I mean, like the way you reduce leverage in the system is by getting people to not, leverage themselves into the system. I mean, ultimately, but people are leveraging in still in, some capacity,
I
right?
mean, so what do
Because they're
they?
still employed.
If their tools aren't actually doing anything, what do they? What is their only real option? And it is to try to convince everybody that their tools are doing something, right?
Yeah, I mean, I think more
And
so,
they
like,
did a great job of doing that in 2022. And I think everybody now is. I think they've lost. I think they've lost the ability to scare people and to control that narrative. And I do think that we run a great risk of reaccelerating inflation. Not crazy unless energy spikes, but durably long term. 3 to 5% inflation, at least for the next couple of years.
yeah, no, and that's kind of so
So
you're saying
aren't we
that
projected to increase deficits by like another like 4 trillion next year?
If it's 4 trillion, then we're easing, right? I mean, the Fed isn't even tightening.
Yeah, I mean,
They're
well, we have 1.6 trillion in the next fiscal quarter. and the Fed's only tightening by what, fucking 100 billion a month.
Yeah, I mean, I think at this point,
I mean, as inflation drops, which is, you know, we've yet to experience a period of consumer side inflation going negative, but you know, as inflation drops, asset like risk assets are going to devalue, right? Because forward earnings projections are going to fall, and like, yeah, I agree that fundamentals matter way less, but you know, deflation is bad for growth, right? And then as in, if we were to have the no landing scenario, as that inflation falls to the wayside, the effective federal funds rate increases, right? Because the spread between inflation and the federal funds rate is going to widen. And that's usually the period in which unemployment goes up the most.
yeah, I think,
So if all of this money, like if all of this money is going into like private holdings and it's going to be, you know, just held as assets in perpetuity.
well, part of this has treasuries, right?
Yeah. But which there's currently like very little demand for, right? We already kind of have a treasury liquidity issue, right? Um, people are spooked because of the potential for downgrades. They're spooked that the Fed's going to raise more. Like it's not there isn't the liquidity in that market that there should be. And we see that in the fat tails that keep printing on our duration, right? But
Yeah,
I mean, like some of like the cumulative effect of all these little things is quite big. And obviously, you know, a significant portion of the reason we haven't experienced a credit event is because there is an outlet to relieve the burden of that rate increase, right? Like, I mean, if mortgages were operating solely off of the back of the federal funds rate, or like 30-year mortgage rate would be at like 10 or 12% right now, but they don't need to do that because they can get, you know, a lower risk-free rate offshore, right?
yeah. I mean, that's another issue that could come into play is closing that carry trade, which I thought it was notable that, um, USD JPY came down somewhat significantly, kind of after they sort of said we're gonna intervene at some point, but we won't tell you when. So good luck.
I mean, they kind of said they're not intervening unless there's like a crash, right? And they're not going to intervene unless there's volatility. And that's on the back of the BOJ also not intervening. Um, I think that's all. I still think that like there aren't enough economists or analysts looking at that. Um, but it's hugely impactful to these banks' ability to lend, because if that shuts down, there's no lending route, right? And the flow of capital ceases.
Well, that's when you see the yield curve start to normalize.
Yeah, we should, right? But that's,
That's
I mean,
that
that's still like a hard landing scenario, right? Because of the amount of assets leveraged into that.
Oh yeah, that's the credit event.
Yeah. But
Yeah,
I don't think it's like a speculative credit event, right? Like I mean, there's probably going to be a little you could say to dissuade me that it's inevitable given whatever period of time. Like it could take a while, but the outcome is inevitable at this point. We've exported so much inflation to Japan that they're going to be forced to normalize rates against,
what was their last print for their GDP? It was like
it was,
-2% GDP, real
yeah, it's
GDP,
way down.
5% GDP.
Yeah, their GDP is way down and their inflation's up.
I mean, it's abysmal, and yet after that, I mean, and yet they still come out and say we're not going to intervene until there's a crisis. It's like those are crisis numbers, right?
Well, think of
That
what happens. Think of what happens just if this is prepared for, right? And there's a slow unwinding of the trade, and banks are forced to return to the U.S. to get their capital extensions from the Fed, and they're forced to pay the federal funds rate, and they can't make money on that spread anymore, right? But there's no crazy volatile event that follows it. Even in that case, you've got let me think of how to put this. You're going to experience a massive reduction in velocity of the money supply, right? Like velocity in the money supply is going to basically move to zero and stagnate.
Well, I mean, then another thing that's going to happen is
And
mortgage
what's
rates are
the
going to go up.
well, yeah, I mean that's going to be part of it, but like what's going to be the realized effect on M2 supply when that happens? Because I mean, you have to assume that the Fed is really, really aware of this, right? They're monitoring all of the GSIBs. They know what the GSIBs are doing with their money. They know that they're still lending regardless of the rate increases. So why? I mean, like they don't need to keep increasing rates, which they've stopped doing for the most part because there's no purpose, right? But they can just hold rates until Japan is forced to capitulate, which they've already started to do. And I don't think it's any coincidence that our like absolute cock rocket of a market rally started the day after YCC was pulled, right?
Yeah, I mean, it's hard to disentangle because it was also, it basically started right as Yellen pulled duration forward.
Yeah, they both happened at the same time. But she like I know everyone jumped on that, but I'm still gonna say that like it was barely a move. It was like a few $billions, and that's not going to affect the movement of trillions of dollars of capital. She cut this quarter for what was it, 84 billion, and then raised next quarter by 116.
Yeah.
So I mean, like effectively over two fiscal quarters, it was an increase in the amount sold, but less duration, right? But the deficit effect is worse. So I don't know. I mean, I agree with a lot of the things you're saying, and yeah, I mean, I do think that we're hitting a period of kind of like stagflationary pressure here, where we might see like unemployment oscillate a little bit and things are uncertain, and that's why I kind of don't think we're gonna see a lot of like downside in indexes right away. Because something does need to push a little more, but I think the mechanisms to create that are already in motion.
Yeah, the one thing that I'm concerned about though, right, is as global credit conditions tighten in terms of these currency pair swaps and stuff, we're gonna see interest rates across the world go up, right? For consumers, not necessarily for central banks. And the danger of that is that, you know, like asset-backed securities are going to go way down in value. Like if the mortgage rate jumps by 25% over the next year, right? MBS just got a 25% haircut. That's kind of what I'm mostly, concerned about in terms of a hard landing is if something like that happens and, private firms are not prepared to handle such losses, and especially if unemployment goes up because that increases the risk of your securities. Um, you could see credit conditions get into a spiral of tightening.
Yeah, I'd really love to ask, economists at the forefront of the soft landing narrative how credit spreads are going to stabilize, because I don't see any viable solution to finding stability in credit spreads, because all of the central banks are in effectively in QT, right? So there's no central bank bond buying anywhere. And you have primary dealers, right? And they can shoulder some of the burden of holding credit spreads stable, but they can only handle so much. They're still underwater on tons of like hold to maturity securities, right? And they can try to pad that on their books with like equity gains, but equities are too volatile, which they experienced over the last 3 months, as they were buying the high and then we dropped 10%, right? And they did everything they feasibly could to stabilize that drop, but we still dropped 10%, right? And then straight lining up out of that drop isn't exactly healthy either, right? Because you run into a situation where you immediately um lose buying pressure and liquidity because nobody trusts the price action, right? um and that's kind of where we've been for the last week, is that there's just really no buyers.
Yeah,
and
it's
and
a
and so like ultimately credit spreads are going to remain unstable. And I don't see how they fix that. I mean,
I yeah, there's just so much that needs to be done, and the tools that are given to us to do them are so blunt. It's just that's the problem, right? And I think that there's definitely a case to be made for both scenarios, no landing and soft landing. Or sorry, hard landing. There's no soft landing. But there is no soft landing because our tools are so blunt that there's no way we could ever affect the economy quickly enough, save from, printing bunches of money and giving it to people.
I
Uh,
mean that's kind of what they did with the backstop, but I think the backstop was done in order to prevent a credit crisis that wasn't large enough, right? I mean, even without the backstop, the GSIBs would have been fine. Like that was gonna maybe spread out further through regional banks, right? But none of the GSIBs were gonna go under, and they would have just expanded on the opportunity, right? JPM definitely did. Um,
yeah,
and
they definitely.
yeah, and so then you just end up with a situation where risk is even more centralized. Like had that gone through without the Fed backstop, and I've thought about this a lot also. We might have gotten some failures in some slightly larger regional banks. We might have seen like Truist go under, and maybe like well, I mean PacWest did eventually go under, but I don't even think it would have spread as far as like Citibank, right? And like after Deutsche or UBS absorbed Credit Suisse, the derivative risk was, or the larger part of the derivative risk was already off the table. So I think like the Fed backstop really just prevented a tiny credit crisis from happening. Um, in the hopes that we would get a larger credit crisis down the road. And since that, the Fed has done very little, right? They've just maintained everything for the most part. We've had one rate increase.
Yeah, I mean, I don't know if it's necessarily that they want to have like a credit crisis, but as long as the risk is sort of more evenly distributed, right, it gives them a more clear message on whether or not their policies are having an effect on, the financial system.
Well, they really need real growth to come in significantly below the tax rate for a period of time to get a soft landing, right?
Yeah.
When you talk about them, sorry, I had someone come to the door and now I'm eating a Rice Krispie treat. But
Nice. That's gluten free.
Yeah, I guess I don't care. I mean, how can you say the Fed's tightening if nominal GDP last quarter was like 8%, right? I mean, like, how do you get around that fact?
You know, there's a bit of a mindset that, growth is always better than contraction.
Bubbles
And
or
so,
bubbles?
yeah, but there's always the assumption, like the soft landing, if we look back at that CPI chart, right, the soft landing, it's that line being, super duper flat for, holy crap, like 12 years, maybe longer. Or it's that we get a new line, right? Like, which is super bad for long-term inflation expectations. So it's really just a matter of, like, if we want to get back to trend, right? It's either going to have to be like a stair step up, and then, GDP, catches up to it somehow with a low CPI, which, I mean, it's possible, but um, there's
Uh,
just no way to actually affect that with interest rates alone.
yeah, I don't know if continued
Yeah.
expanded growth is sustainable without much higher rates of inflation, right? We're going to lose dollar value. So
Well,
if
yeah,
if
but
growth if growth maintains at like last quarter's rate, and we've already seen growth double, growth estimates double for quarter four in the last 3 weeks. Like if that trend persists, the economy is going to overheat very quickly.
I
Yeah, I
mean,
mean,
well,
there is no. I don't know. I'm obviously being hyperbolic and maybe almost for the sake of just being contrarian, but
No, it's good. I like it.
I mean, you we printed 40% of all the money, right? You can't just pretend like that's not just gonna push through the economy regardless of what you do, unless you crash it, right? And I don't know how you're gonna stop the economy from overheating without extracting that money. If extracting that money is off the table, which is what it seems like it is, between the Fed and Congress, you can't stop it, right? That's the fact that there's 40% more money now than there was in 2020. There's nothing that you can do to offset that. It the growth, and I think all the growth is inflation, right? I mean, we've grown 26% in 3 years. That's all inflation, and it was so quick. I mean, it's all inflation, right?
Yeah.
It's
yeah,
all from that impulse. And I was arguing with somebody on Twitter, which now that I say that out loud sounds awful, but this wasn't really arguing. I was just telling them they were dumb, which I guess is arguing. But there's somebody who said that the idea that inflation was transitory has become true, and I really want to push back on that. People talk about the supply chain, causing a just short-term disruption that we recovered from. Well, yeah, but if it was just the supply chain disruption and it was truly transitory and had nothing to do with the fact that we printed 40% of all the money all at once, well, over the course of a year and a half or so, then we should have seen deflation, right? I mean, we should have seen deflation with as much vigor as we saw inflation, right? As the supply chain eased, the inflation should have recovered. And even if you look at goods, right? Even if you look at consumable goods, which have probably shown the best amount of deflation overall, those goods have still not returned to the original CPI curve that existed before. There's still an inflated value built into that. And that can only be explained now that the supply chains have mostly corrected themselves by the fact that we printed all this money. And so I don't think there's anything, if even like a global supply chain disruption couldn't stop this train of 40% of all the money being dumped all at once, what's anyone else going to do, barring a credit crisis, right? I mean, unless M2 crash, somebody's got to crash M2. The Fed
Well,
and the
global
government.
supply chains are gonna. Well, here, hold on. Here's one thing that needs to be considered, right? Is that global supply chains are going to break down because we're we're exporting our recession internationally, right? So you've got Europe's what 2 quarters now of flat to negative GDP. Great Britain's flat to negative GDP. China's GDP is falling quickly, right? Even with them lying about it, it's coming in significantly under estimates. China's industrial production is down. That's the second largest country in the world. Second largest economy in the world. Germany is the third, right? And they're in a recession. I mean, they haven't declared one, but they're like 3 quarters of negative growth and increasing unemployment. We see unemployment going up in Japan, China, Great Britain, all of the Eurozone, South America. I mean, Mexico's economy is maybe the best performing in the world right now, and that's just because we're offshoring. We're moving our means of production there, right? But most of the S&P 500 is multinational corporations, and if you have recession globally, right, and we've managed to withstand recession domestically, there's no one to buy our shit, right? And you're going to get a collapse in profits growth. If the dollar value drops, exporters are going to be hurt even more because they're going to lose on the exchange. um like again, something that's just kind of inevitable. Like all of these countries are already really right there, right? And like and meanwhile, we've tightened above them in order to keep our currency valuation highest, right? Because you know we are the global currency. But as their rates increase, right, and they're as this continues and their yields drive up, in order to compete and keep the dollar uh, in the top spot, we're gonna have to raise rates a lot more. And if we don't, then everything comes home to roost at once, right? The dollar
I mean,
value will
what's
decline.
the end game?
Energy prices are going to double, quadruple.
What's the end game then? I mean, it seems like the ultimate end game will eventually be the United States selling so many bonds and pushing the yield up so much from the fiscal side that starts to becoming a drag on the economy.
I mean, I feel like Yellen's already doing that, right? I mean, we're
I
printing.
mean, she's starting, but it's
Yeah,
going to take a couple more quarters, I think, to really start to become a crisis.
we got a 20
Uh,
year on Monday.
I'm
We keep
excited for that.
we keep
Very
printing we keep printing 30-year historic tales on our treasury market, and that's
excited.
not a good sign in the confidence of our economy moving forward, right? And then Moody's is probably going to downgrade us, and then we enter a period of like, are we going to see continued downgrades, or is US credit going to move to A or AA, right, from AA plus? Like because like you said, the deficit spending is not going to stop, right? They've got a clear runway, out for like 2 years.
I mean, the thing is yeah, and we have an election cycle coming up too, right, over the next, 2 years. So I think that everybody, all the representatives, are okay with the economy growing, even if it is overheating.
Yeah.
I mean,
All right.
I don't think fiscal policy really is gonna do anything to prevent an overheating economy, right?
Well, they could cut deficit spending, and that would slow down the overheating economy. But no one's going to vote that in when they're about to get voted back in. All the incumbents are going to want, economic growth over.
If we spend all the money, here's what's frightening about that though. If we spend all the money, like all the government subsidization comes in before the recession, and then we get a recession, there's no way to claw back out of it.
Yeah, I know, and that's been my worry.
I mean, that's kind of what happened to Japan for 30 fucking years, right?
Yeah, and this has been my worry the whole, for a long time now, is that, we're going to get into this situation where our debt is just less valuable and for the foreseeable future. And so for us to try to, to get an advantageous position with respect to economic growth and deficit spending, it's going to be way harder. Yeah, and that's sort of the situation where you get into the lost however many years, right? Is because you have to rebuild your credit as a nation. So that's kind of where I'm at in terms of this economic growth and soft landing thing, and where I think we all kind of stand in the same sort of area where it's chaotic, but it's not a landing yet. We don't know if it's going to be soft or hard or no landing, right? But we do see two opposing forces in the economy. The giant pile of money still sifting through the whole system, and at the same time, tightening credit conditions for the end users of this dollar system.
Yeah, I would say that a soft landing actually would just require us to be able to say that the job's done while maintaining the current rate.
Yep,
uh,
absolutely.
and I don't think we could say the job's done until there's some capitulation between 15, 30-year mortgages and the yield curve.
Yeah, that's 100% true. Like, we haven't seen the equalization in the housing market.
We won't
Right.
until Japan's off, like Japanese money laundering's off the table, right?
Yeah, that's true. I mean, but the effect of that is that the spread between, mortgage rates and the treasury yield is going to be way higher.
Yeah.
And that's a huge deal. So like the soft landing still just doesn't lead to a soft landing. Like there's no easy way to do that, because all we'll do is we'll tighten the housing market even more, right? And it's not only just housing, it's all kinds of fucking things. And once again, the consumer is going to amortize more because credit card rates are going to go up in response. And then the economy is just naturally going to want to slow down, right? People aren't going to want to take out as much debt for that fancy thing they want, right? I mean, I almost bought a truck with there's gonna be like $100 monthly payment for a year, and I was like, dude, that's not bad, but that's going to dry up really quickly, right? Because APRs go from like 17 to 20 up to like 20 to 30. Like, no one's going to use a credit card at that point.
Yeah.
I don't know.
I'm stellar credit.
I'm a snob. I've never carried a balance, so
it's
yeah. I mean, but you're like you're not carrying debt at that point, right? You're just using your credit card for its like as cash.
Yeah.
So I mean that doesn't really apply. If you're it's more if you're carrying a balance. It's people who have like large durable costs coming up, right? People who just bought a new home and need to furnish it and buy appliances for it, and write off fucking unexpected repairs, and that's where that credit card utilization is going to pick up, right?
Wait, I thought everybody just did what I did, which is move into the house with all your old shit and just very slowly replace it over time into this like smorgasbord of shit doesn't match.
You're a hoarder. That's different.
Yeah, I mean, like what I do with mine is I just like if I want to buy something fancy, I'll put it into like an interest rate calculator and like get a set of fixed payments if it's really big, but that's those fixed payments are going to go up, right? And that's if you manage your debt like with large purchases like effectively. Uh, but as those costs go up, you're just going to be less and less willing to buy those big ticket items that you don't necessarily have the cash liquidity for.
Hey man, I just got offered 9% on a reverse mortgage. So
Oh, for the grandma house,
yeah,
9%.
yep.
You gonna get into some junk bonds with that?
I'm not taking a reverse mortgage, but I thought the rate was exceptionally high.
Yeah, that's pretty high, but 2% above current national average for mortgage rate, roughly.
Yeah.
I mean, it's basically a HELOC, right? So it makes sense.
Yeah, it kind of is.
So yeah, like I mean, reverse mortgage versus HELOC, you're doing the same thing to me. But that's a lot of money.
Yeah. Yeah.
You just got
Just go long.
instead of one.
Just go long TLT.
Yeah, dude, 2-to-1 leverage.
I'll just buy shares at that point.
Fill your house out from under the reverse mortgage.
They still send me the mail, Mr. Poopy Pants, and it said I was pre-approved. Don't tell me what I can do. I could be 62 if I want to. It's my birthday.
So, can we go to the options market now? I kind of want to.
Yeah, let me go over the macro a little, and then we'll have JFresh do his sexy options things, and then I don't see your usual corporate bond charts, so this should give you a minute to grab them.
Oh, they're flat. I mean, I
know. I looked at them too.
Yeah, they haven't really done much.
So yields are continuing down with dollar dropping. We hit a new low on Wednesday, right, or Friday morning, and then bounced back into the end of the day. The mid range between like the 6-month and the 10-year on the curve has stayed mostly stable this week, with the biggest losses being in like the 20 and 30 year. Core 3-month kind of flattened out into the end of the day on Friday. Core 1-month still hasn't turned around. This is kind of interesting. We saw a big increase in the forward convexity returns on VIX after the Japanese Ministry of Finance announcement. And this increase in vol, if it continues, may start to give us some confirmation that the carry trade is breaking down. If we go back, yeah, this is kind of interesting. If we go back to like, and this is on the weekly, but if we go back to like 2008, which is the last time the carry trade broke down in a significant manner, you can see that into the carry trade, the baseline of vol until we got a market crash just continued higher, right? So those forward returns on the vol convexity that attract those bond hedges keep getting higher. And something interesting about this run is that we kind of had more put selling, I think, than we've ever seen on any of these big spike ups, right? Like, I mean, I showed you the futures put selling, and they're selling like every fucking strike. Like not just like the the 4400s and the 4100s and the 4200s and then the $25 agreements. They're selling every every fucking strike where they can get liquidity to sell puts. They're selling them in mass, like as many as the fucking will fill. They're selling them for 5 cents, 10 cents, 20 cents. Like like fucking across the entire options chain, all the way down to like, was it like 3,400? And so that's really interesting, and we see that kind of expressed here when we look at correlation between VIX futures and spot VIX. And it's, moved substantially more and more negative this week, but over the entirety of the week, it's dropped 10%. It's now 10% negatively correlated with spot VIX. And then we've seen volatility on VIX over the last 2 weeks move positive, right? Which is, I think, one of the reasons we haven't seen VIX go down to like where we saw it back in June and July, those like $13, $12 levels, right? Is because there's simply too much demand on long vol. And over a period of time, that demand on long vol that exists is going to be expressed in realized returns on volatility, right?
Yeah, and I mean, we saw it. So, October 20th, right, was really the only day we saw, October 19th, I want to say 19th or 20th, kind of both those days was the first time we really saw the bond curve and the volatility curve sort of, I don't know, normalize, I guess you could say.
Oh, here we're like into the end of October.
Yeah, like right around there. Yeah.
Yeah.
We normalized a bit there, and uh, that was, I think that was pretty much right when Japan made the YCC decision.
Yep.
It was something like that. So
So yeah, you had the YCC decision on the 30th.
yeah,
And then
so
yeah,
this
we
makes
see
sense, right?
forward returns on vol drop immediately. But this behavior, like this, like yields down, vol down, equities up, that's like risk off, right?
Yeah, no, yeah, because
This
so
isn't like, this isn't indicative of like confidence in a strong economy moving forward.
well, so what we see is we're seeing credit conditions tighten more, right? In the short end, and at the same time, we're seeing vol drop, which means demand in long vol futures is, reducing,
Yeah.
right? And that's just a sign that liquidity is drying up, or at least it has gone down an appreciable amount. So, this isn't necessarily like what we had before was kind of a healthy pullback, you could say, because we saw higher demand for volatility products,
Yeah.
but then that demand just dropped off after the YCC decision. So it tells you people are, yeah, they're not risking on into leveraged assets, right? Because if
Yeah.
they were, they'd be hedging their portfolio of treasuries that they're buying with long vol.
And what does that tell us about the drop in yields?
Well, that it's not people going long. I mean, that's really about it.
It's buy to close, right?
Yep. So just to to bring it all full circle, I think in a decent way, like why we've seen the market bounce like crazy, and and so inefficiently too, right? Like this wasn't like clean candles all the way up, like at open max liquidity fucking pumping through intraday. We're
Yeah.
seeing these crazy gap ups, and that's just you know it's not a sign of good liquidity. I mean, we could
Wow.
use indicators and math and whatever, but I mean, like you could just look at the way the market's being priced right now. It's just stair stepping up, like without crazy intraday swings, except on a couple days, right? You just step up, and then the delta exposure to the market maker just pushes it up the rest of the way.
Yeah, I mean, I think pretty clearly there's not a lot of price discovery going on.
No, no, we're not discovering anything. We're discovering how high the price can go.
So, you know, what happens when a short squeeze is done?
Well,
You go
usually
down.
it normalizes.
Like, if this is a market short squeeze, right? I mean, it's a bond market short squeeze. It's a equity market short squeeze. It's a long vol short squeeze, right? Or, well, yeah, it's a long vol squeeze. Um, and it's kind of petered out over the last 3 days. We had some stagnation in the prior week, but it all moved to the upside, right? Even on our lowest volume days, we were constantly ticking up, and then these last 3 days specifically have just been flat, right?
Yeah.
And I'm sure JFresh is going to come in hot with this, but there's just not a lot left to the upside of us on the chain. Like the FinTwit bulls talk a lot of shit, but I didn't see any of their 45.25s or 30s or 40s or 50s printing this week, and I definitely saw them lose a shitload of money on long 4600s.
Yeah. That's pretty much it summarizes it pretty well. Like the we're not doing stuff that is, necessarily in line with risk analysis expectations. In fact, we're quite far from those. So we when we talk about megaphones on like the intraday, right, and how those work, right? Megaphones on longer time frames, they function they function in a similar way, but on a much larger scale, right?
Yeah, yeah.
So like now we can talk about things like, is any of this part of a Monte Carlo simulation at this point? I mean, some of it, but certainly not all of it.
Hey guys, sorry, my internet cut out.
No worries. Welcome back.
Yeah, I heard you. I'm assuming you guys are still talking about the awesome liquidity and perfect price discovery that's occurring right now.
Yeah,
Oh
yeah.
yeah.
But we're gonna pass it over to you to talk about how fucked up it all really is.
Give it to us straight, Jay Fresh.
Do you want me to give it to you straight?
I mean, you know me. You don't always have to give it to me fully straight.
God damn it!
He
You're
wants
so gross.
he wants
All
you to give it to him, guy.
Yeah,
No,
that's what I'm implying.
no homo.
Okay. Well, first, everybody go to Twitter and read my tweets if you haven't. It'll not because I'm promoting it. I don't give a shit if you even like it or whatever. But
Shameless.
there's a lot of it's
Shameless Shillery.
a lot of it's just explained there. So, but if you want, I mean, if you want to just pull up that thread, that would be easiest. Or if you want, I can copy and paste the figures into the Discord if you don't want to go to Twitter.
I just posted your Twitter handle on the Twitter handle on the chat. Everyone can go follow you and turn you into the FinTwit you always wanted to be.
I don't. Honestly, I'd prefer to talk to people on the Discord than.
Oh, I missed an underscore.
How the fuck? Why is your post on your feed like only show the middle? Never mind. All right.
I don't know how to use Twitter.
It's okay. It's okay. I got it.
Yeah. Okay, so I was just asking myself. Well, we've been collecting all this data, and we look at it on a ticker by ticker. We usually look at it one ticker at a time, and I was like, what does this look like in aggregate? We're right now we're only looking at about 210 tickers, which include some large indices, and obviously there's 10,000. There's a little over 10,000 stocks, not on the OTC, on actual exchanges, but really there's only like 900 or so stocks that are any sort of reasonable valuation. And of those 900, the 210 that we follow, it's like 90 something, like mid 90 something percent of the dollars moving around on the options chain. So we're basically looking at most of the options market. So I was just working on aggregating all of this stuff together, and what I found was actually kind of interesting. So the first thing is the gross market contract value. So how much money people have put into contracts, right? So if you think about it, like, you know, regardless of basically this estimates, you know, how much money is in the options market directly. And if you think
Well,
about it, like,
equity options, Mark, or you have other,
yeah, just
you have,
equity. I'm
yeah.
so I'm not including futures, and that's something that I want to think about including in the future because I mean,
It's like
future
twice the
options are
size.
significant.
Yeah.
Well, I mean, futures in general swamp the dollars moving around in the market by like 3 or 4x, right?
Yeah, it's
It is
huge.
the single most prolific thing in the market. Coming in second is index options. You know, index options being the majority of what's left, and then the meme options make up a lot of the rest, and then most of the volume in the market is just options hedging. So anyway, the equity options are largely since futures are. Give me 1 second.
What's up, Cobra? Thank you guys for the birthday stuff while I've been talking.
Yeah.
Just only 400p.
Yeah. Sorry. So you know, a lot of this, you know, a lot of futures intraday, like high volume movement is hedging index options and things like that. So you could make an argument that you know, the options market is doing a lot of the heavy lifting on price movements, you know, over time, and it's kind of interesting.
Are you
You,
saying
you
that
know,
options contracts aren't simply insurance?
no.
That's not what I was
um,
taught at school.
Options contracts move the market from hedging. I mean, the hedging volumes, just rudimentary estimates of the hedging volumes basically encompass, I mean, they basically match all of the volume on underlyings, right? And so either nobody's hedging and everything's just working out perfectly, or options are running the show. But I thought it was interesting that the contract value sort of has stayed constant, if not slightly declined over time from Jan 2022 to now, which, you know, seems kind of interesting because you'd think as the money supply increases that there would be more money in options, but there's actually less money in options this year than there was last year, with some exceptions.
That's a factor of like liquidity, though, right?
Yeah, I think so. I mean, it's an indication that even though we've printed a lot of money, liquidity, there is some liquidity issues drying up. And what's interesting is I split this up between puts and calls. And the one thing that stuck out to me a lot, which I want to run a quick regression on at one point, but I'm pretty sure I'll know the answer, is that the total aggregate value of puts pretty much tracks the VIX. One to one, right? I'm sure if I plot that correlation, it's going to be like 0.95 or higher.
Jesus.
Which just goes to show you that, I mean, the VIX is simply a measure of put demand. Full stop. I mean, I'll run the numbers before I, you know, dig any deeper. But the VIX measures demand, and it seems like if that's true, then, well, I don't want to spectate too much on that, but I mean, I thought that was striking, but anyway, if you look at it, I mean, in 2022, the value of these contracts between calls and puts kind of oscillated between each other in roughly equal measures, right? So there's like 450 billion in the market, and that value oscillates between puts and calls around the 225 mark, right? And so we kind of had this extreme volatility on the way down. And all of that volatility can likely be explained from this dynamic here of just the instability of the options market, right? So that there is you put this much money in, you're going to get a certain amount of instability. But something interesting happened right this year, and this is kind of just showing in more detail, some of the theories that we've had and just making them stronger and importantly trying to quantify the effect of the dynamics that are going on. Because if you can quantify them, then perhaps that you can become more predictive about where it's going to go in the future. But what's interesting happened in Jan 2023 is that the put value of the contracts went down and just kind of stayed down. Like the oscillations basically died out, right? And they're kind of coming back now. But we had this very strange period of very calm. And conversely, we had these call options. The value of call options in some cases became upwards of like 80% of the value of all the contracts in the market.
Just to clarify here, this is also a factor of moneyness and the options on the chain.
Yes,
so the more calls in the money, the more delta those calls will carry. The more puts in the money, the more delta those puts will carry.
There's a couple. That's true. There's also the impact of leverage, right? So not each contract has the same amount of leverage. And so that's where this next chart is, where we look at the gross market delta value of the contracts. And you can see here.
That's what I have pulled up.
Oh, okay. So on that
Thank
one,
you, someone.
that
keep
looks,
going.
Oh, that looks at not how much money people, the value of the contracts themselves are, which is how much money people have put into the market. This looks at the output, right? It's an amplifier of money, right? And this is why people use it to move the markets, because it's a bigger lever than just trying to buy and sell equities directly, which is a fool's game at this point. You can't compete with somebody with 10x the leverage of you. So everybody just uses options to move the market, and so the options. So I know I'm going fast. I'm trying to get through a lot.
Do you want me to go to the leverage ratio chart?
Not yet. Not yet. I want to make a quick aside here, and I think everybody here already knows this, but the market is basically manipulated, right? I mean, the whole purpose of the market is to manipulate, and so sorry, my wife is throwing a party, and I have to go do that at some point. But I told her I'm finishing this phone call. The market, the purpose of the market is for big money to manipulate prices, right? There's really no other purpose for it, and I think that this data lays that pretty clear. But anyway, so back to this gross market data. If you look at basically the output leverage, the values are roughly the same, right? And it's interesting because it's like $3 trillion just sitting in a $45 trillion market. It's pretty substantial. And if you look at it, so even though these puts have much less value, if you look at the gross output, it's much more comparable to calls. And the reason for that, if you go down to the contract, if you go to the leverage ratio chart.
Got it.
Like average of 6 for a contract up to 12, right? And even as high as 14 this year. And so what that's telling us is that people are selling a boatload of puts. And if you look at the call leverage, I mean, the call leverage really hasn't done a whole lot, right? I mean, so most of the effect of the calls gaining value is just the calls that are there going in the money. But the calls aren't really doing a whole lot of driving, right? Because the leverage is double for the puts. And if you go even further and look at the number of contracts, there's let's see, 2, 8, and then this is, yeah, there's twice as many put contracts out as there are call contracts. So there's twice as many put contracts with twice as much leverage. And so those are kind of running the show. And so what's really interesting that we saw, in this spike is that the thing I want people to understand is that there is a finite amount of money in this ecosystem, right? There's $500 billion in, and there's on the order of, $2 to $4 billion or $2 to $4 trillion out, depending on, leverage ratios and all of that. But it pretty much stays the same, right? And so you can only go so far in one direction before there's nothing left, and you have to either add more money to the system or take money out, right? But if you're not doing that, which is what's occurring, then you can start to try to predict, when these runs will end and when we start moving in the other direction. And so what's interesting from this pump over the last week is that we have a sense.
You cut out. Nope.
Here, kitty.
Can you guys still hear me?
Bruta.
Now we can.
Okay. How
There
much
he is.
how much of it did you not hear?
Just like the last 30 seconds.
Okay. Yeah, I thought my headphones did something weird, so I stopped and checked. Okay. So if you look at the last few weeks, we basically, as Kirk said, I think driven largely by bond market imbalances, we basically just short squeezed.
Yeah,
But
it's really obvious when you look at this chart, your contracts on SPX, where you can really see the rate at which puts move out of the money and calls move into the money. That most of this, a lot of this price action was driven by that cover bid and futures MMs going long SPX on the call side.
Yeah, and so so I think some calls came in and a lot of puts sold, essentially just repelled the market upwards through all of that gamma. But here we are still sitting on nothing's changed since the last time we were up here, right? Except actually, well, things have changed, right? Everything's worse than the last time we were up at the 4,500, 4,600 range. And so, I look at all of this data and it tells me that it's unlikely we're going to go much higher. Calls are already on the order of 2,200 billion, $2.2 trillion, and we never saw that in 2022, and we only saw that very briefly in June and in that July, August timeframe, right near the top before we started spinning back down the other way. So we're in a very unstable point, and signs are all pointing down and not pointing up, right? That doesn't mean we have to go down, right? There could be, enough propping up from other sources, like say futures or something that could try to continue.
Is this as of Friday's expiration? Because that's a fat chunk of in the money calls closing.
So you can see that if you look at the market delta, that does include Friday dropping off. So it goes from 2.3-ish trillion down to about 2 trillion. So $300 billion in value. Whereas the puts lost almost no value, right? They're already at the bottom and they can't really go much lower. And so there's only one real direction for this to go, either flat or down. And when I say flat, I mean within 100-point range. So that's why I kind of said 4,500 to 4,600 is likely going to be the top for a while. So either they can maintain this long enough that they can unwind this dynamic, or this thing gets pushed back the other way.
So I was watching Friday really closely at like the big expirations on the chain, you know, like in the VIX window and like our 0 and like 5 DTE expirations for this coming Friday after Thanksgiving. And it seemed like the support that came in to stem the sell-off from the collapse in Charm was very short-dated. Like for the most part, like 0 and 1 DTE. With I would say most of like the 4500, 4505, and 4510 interest coming in 0 DTE.
Yeah.
So that'll have most of that'll have expired by Monday, and I'm wondering, are why Charm didn't collapse more? Is that the monthly expiration, like the end of the month expiration, counted in the SPX in the SPX chain, not the SPXW chain?
Yeah, there's a quirk. There's a quirk on the SPX chain. That it and I'll have to go through and do this. So when I calculate it on the day of, because it's all like a day behind,
Yeah.
I just lop off that data so that when you're looking at Monday, so the data that's shown on Friday is for Monday.
Okay.
But what's interesting is, yeah, you're right. I mean, Charm didn't fall off nearly as much as you might expect it to, which is a little scary. And I think that's largely a function of the fact that the December expiration is absolutely stacked. Like,
I've seen
just
it.
like,
Yeah, it's ridiculous.
it is frighteningly stacked.
Well,
It's
that's
like,
the make or
it's
break,
like
right? That's right after FOMC.
it's like 65% or more of the entire options chain, right? So you think about that, like $500 billion. There's like 300 billion of that is just December.
That's insane.
And I don't know what to do with that other than just be very afraid.
Prediction might be right.
But this is the interesting thing, because everybody's talking about their Santa rally, and we're gonna have to hear it's like Christmas music. It's everywhere. Nobody shuts up about it, and you just have to live with it until after Christmas, I guess. But I actually like Christmas music, and I know that this is why we can never be friends. But anyway, I mean, the Santa rally requires fuel, and there's no fuel, right? I mean, all the money, all the contract value right now is in calls, right? So if they want to, it, it, if they're not going to add, if money's not being added to this system, if they want to sell more puts, right, which they need collateral for, they're going to have to sell some calls, right? And if they sell calls, it's unwinds. And so we're kind of sitting at a point where they either have to hold it and hope, or unwind.
I think most of the out of money calls right now are mostly sold. Like there's just the bigger concentrations are so there's not a lot, right? First of all, there's just not a lot of out of the money calls at all. But the bigger concentrations of them are super fucking far out of the money. So
there's only like 800,000 contracts out of the money and 3 million in the money.
So, Chris, you're reticent to toot your own horn, but I just want to tell everybody listening that DD is excellent, and you should go read it and look at these charts more, because this is really good data, and I just want everyone to appreciate that fact. So thank you, Jay Fresh, for doing this. I love these charts.
Gross. I'm not gonna pretend. I'm not gonna pretend like I didn't like that, but how embarrassing for you.
I'm not afraid to admit when data looks beautiful.
I mean, I was pretty. I sit around and think about all this shit way too much, and then I come up with an interesting question of like, how much money's in the market? And I was like, oh, I actually might have enough data to start answering this question. So
You guys
really,
weren't on the stream back when I wrote the like liquidity DD. But Dork had a hard boner for that DD for like 3 months.
yeah, I mean,
he loves DD,
I
man.
mean, you only get one life, you know. You might as well be excited and be positive, and yeah.
When people present axioms and aggregated data, I just get both of those things will just get me so tickled. I love it. I'm so stimulated by that.
Well, now that we all know what's going on in his pants, yeah, I mean, I think that's about all I got. I mean, so just from a structural frame of reference, I mean, we're definitely becoming unstable, right? I mean, they were able to kind of like quell the instability for a little while, but like in the July timeframe, but we're definitely now back in this unstable oscillation between calls and puts, and that instability is accelerating.
I think I kind of want to. Can we phrase it a little differently? Because structurally, what's keeping our price here is in the money calls, right? We know it's not out of the money calls. We definitely know it's not long puts, or so it's just a shitload of in the money delta, and I think a lot of that is sold, right? Like when we did that gap up this week, there was already like a lot of like short call interest coming in, and I think like the call interest below like 4,500 is basically all sold. Like I don't think a lot of that's long calls. I mean, we know the 44.25 strike is sold, right? That's 10,000 contracts. We know the 45.15 strike is sold. And I think a lot of everything, like they all like all the call sellers kind of jumped onto the baby collar and sold above it to use it as like a buffer for their sold call positions. And now we've got a bunch of like long call delta falling off into Friday's expiration, right? Which kind of leaves us in a weird spot as far as hedging goes, because as price drops into sold calls, the the cover bid goes to the downside, right?
Yeah. No, I mean, I think, yeah, sure. I think just in general though, this is gonna I think this is gonna go back the other way. I don't know how violent it's gonna be, but it looks like it's gonna be pretty violent.
The technicals strongly support you.
It's just a matter of like when, right?
Yeah.
Is it gonna start happening on Monday and then just accelerate from there, or are they gonna find some new way to prop it up? I think it's gonna take a few days to see sort of which path we take to back down, but we have to. I mean, there's too much coiled up for this to not unwind somehow, right? And if they can find a way to unwind it slowly, that's great. But that task has become very difficult now.
Did you want to talk about this chart at all? The percent SPX above November 1st, 2021?
Oh yeah, that was just earlier. I mean, talking about breadth, the nice thing is that December 1st, 2021, or sorry, November 1st, 2021, kind of about where we're at. We were a little higher at that time. We're at like 45.50-ish.
Yeah.
So we could say we were, right about in the same spot. VIX was actually higher then, as we were rocketing up into, up to 4,800. Actually, a lot of things are very similar there to here, and if you look at like the macro, everything has deteriorated. So this percent SPX above the November 1st is basically how many stocks are now, essentially back to that point where we were about 2 years ago. And it's only like, I mean, before this run, it was like 28%. It was abysmal, right?
Yeah.
And even, this run got us back to, this run still didn't get us back to where we were the last time we were here, 4,500-ish, back in September. So breadth has continued to deteriorate.
Yeah.
Despite us rocketing and everybody saying breadth is improving, because I mean, IWM shot up like 5% one of those days, but then it shot back down, and it actually hasn't improved relative to how well the meme 7 is doing. So I mean, again, and the meme 7 hit its all-time high market cap, even relative to when we were at 4,800 in 2021. So I mean, we have an even more concentrated market, so it's a weaker market in terms of breadth. Bond rates have dropped, but are actually still higher than they were in September.
Yep.
Right, so the bond market is weaker than we were the last time we were here, which pulls, which has a negative draw on equities. And what else? I mean, there's just not much left in the tank in terms of the options chain, unless somebody dumps more money into the options market, but that doesn't seem to really be happening. So yeah, I mean, everything in me says we're going to 4,000, but
well, it's okay. You're locked into that prediction anyway.
That's true. I already drew that last. Yeah. Anyway, I did my data dump, and I hope you guys followed some of that. But yeah, I mean, I could see going up to 4,600. They can maybe juice a little bit more out of it, but at that point, it's like 90% of the value's in calls and not puts, and that I mean, that's got to unwind eventually.
Yeah.
Yeah, the futures pricing of equities is totally overextended.
Oh, also real quick, got to talk about Microsoft. What a mess.
Yeah. It's kind of a shit show.
What do we think is going to happen this week? Is this good or bad for Microsoft?
I mean, it seems like Altman's being reinstated, but that's going to draw a lot of questions about why he was removed in the first place. And like, the employees coming out and backing him and the president coming out and backing him is a good sign. And like, they might be able to brush it under the rug as kind of like a power grab, which may be what it was, right? But if there was a reason, and there's a lot of rumors of what that reason could possibly be, most of them kind of center around not being fully transparent with like venture capital, but if that proves to be true, that could be disastrous for OpenAI, obviously, and a lot of valuation in the market right now. What, like $3 trillion of money is kind of pinned to the success of that.
Yep.
Yeah, OpenAI
and this is going to shake investor confidence. Either way,
how much it does, right? Yeah, I mean, there's all sorts of threads that you can unwind here, right? I mean, the basic story was the board very suddenly pulled Altman from the CEO role and removed him from the board, and then the president of the company, the chairman of the board at the time, who for some reason wasn't at this meeting of the board, like it's a special board meeting. Why wouldn't the chair show up? That he was called at the last minute, and I don't even know if this board meeting was even legal. I mean, if the chairman didn't even know.
I mean, you can. It depends on like ownership and stuff like that, but you can hold a board meeting without the chair present.
But you can't hold it without notifying the board with a certain amount of time in advance that it's occurring.
Yeah.
Anyway, that's not here to there. So they removed those two folks, and then there was a backlash. But what really pushed it was Microsoft CEO started making calls very quickly. It turned into the whole board is now going to be resigning on Monday, and Altman is coming back.
So I heard I heard that the board is kind of waffling on.
They were waffling, but
Okay.
I think they're out now. I think
Okay.
they're done. And all of this hinges on the fact that they have a very strange governance model. Because they started as a nonprofit, right? The whole point of OpenAI was
Yeah.
to try to build AGI and do it in a way that's open and transparent and safe, because it could be so dangerous.
Yeah.
Quippy 2.0 is going to kill us all. But then they realized that people really liked it and they can make some money off of it. So they made like they made like a tangled web of subsidiaries to this like master nonprofit entity, to have a portion of the company which is controlled by the nonprofit be profitable. And everybody's invested in that company. They're not invested in the larger OpenAI nonprofit. They're invested in this little piece of it that's allowed to have profits, but they're capped. And then after some cap, the remainder of that money goes back to OpenAI's nonprofit arm for research and all of that, right? And so that's created a lot of tension on the board, right? There's people who started it wanting it to be a nonprofit and open and more of a think tank than a cash cow. And that came to a head with Altman, who is, obviously the team cash cow, and team think tank cut him. And then Microsoft, who's on team cash cow, said, no, this is not going to be a think tank. This is going to be our cash cow. You're gone. But yeah, I mean, all this is very interesting to see, what the dynamics are that are occurring in this industry. And I think it's shocking to me that Sam Altman, he's a college dropout. He's a fundraiser. He doesn't know any of this shit. He's never written a research paper on AI. He's never done any seminal works. He's not like a big player in the field. He's just good at raising money, and that's that was his role as president of Y Combinator for a decade or however long he was there. Was to raise money for people, and so that's what he's doing now, right? That's all he knows how to do is raise money, and so it's no surprise to me that he's off in the Middle East trying to get sovereign funds to fund his next startup and doing all this other stuff. That's all he knows how to do. But what's interesting to me is that the CEO of Microsoft intervened on behalf of a fundraiser and not on behalf of an AI master, right? The AI master was the team think tank who tried to cut him out, right? He chose the fundraiser over the technical guy, which I think speaks volumes about what's going on here, right? This is a hype machine. This is a cash grab, and this isn't real, right? I mean, that the productivities that are being promised just aren't likely to be real. And I don't know, that was the most shocking. Well, actually, the most shocking thing about all of this is that the OpenAI board uses Google Meets.
They probably also use Bard. Bard handles all their Google Meet scheduling.
Probably, yeah. Anyway, so I mean, I think so. Like, what's going to happen to Microsoft? I mean, on Friday there's a little bit of sell off because people were scared. I don't know. I mean, chop.
Yeah.
Yeah, it's gonna probably be a lot of chop. A lot of uncertainty. What this will do, at least in my experience with news things like this, is it will cause people to dig deeper, especially those who may be over leveraged. And I don't think AI is something that can withstand a lot of scrutiny.
No,
So
absolutely not.
that'll be scrutiny was not something that anybody wanted. That's probably the main reason that this has been resolved so quickly. And but it's already out there, and once it's in the wind, there's no stopping it. So things may not look so bright for AI in the future because of this one event, or at least investor
I mean,
confidence in AI.
to be fair, this never should have been that big of a deal. Like, there's a CEO shakeup at a shitty nonprofit in California, right? Who cares?
But the
What
fact
the,
but
the
the fact that it's
it's
so
been pumped
important
up to
makes
become
everyone care, right? Someone sold 1 million shares of Microsoft in like 5 minutes. That's gonna make people dig, especially if they own 1 million shares of Microsoft.
I
Yeah.
hope they dig. I hope they dig.
I mean, if anything, too, what this like will bring is more scrutiny to earnings, right? That's really where, I mean, in terms of big changes in price discovery,
Yeah.
earnings.
It's still so hard though, because most of the money's in private, right? It's in VC ventures that are private and small, and a lot of the fact that money's just being incinerated by AI is being hidden at this point, and it's not going to become clear until the money dries up and AI companies start going under.
There is a huge amount of wealth at risk, and private wealth at risk in AI and
Yeah,
AI startups, and
and
it's those
under
people.
the hood, they're
Those
all
people.
already getting upset because it's not making money. It's
Yeah.
not making money to the tune that they've put in.
Those people don't
Right.
like controversy. At all. But yeah, the profitability isn't there.
Yeah, and soon enough
Yeah.
they're going to want their money back, right?
Well, I mean,
Mm.
in venture capital, most of the money gets burned for the hope that you get a few that pay off, right? But
Well,
they're
it
all
depends.
getting
I mean,
burned,
how much
right?
of the venture capital was given out as debt, right?
But if someone stems the flow of capital into AI startups, that's gonna hurt Nvidia, right? The shovel seller. If no one's paying for the prospecting claims, the shovel seller is not going to make any money.
Yeah. Well, Nvidia's got brand new chips for China that totally aren't H100s that became H800s that became H20s.
It's
They're
amazing.
all
You know
very
what?
different.
It's very impressive to me how they keep doing this, but quarter over quarter TSMC turns out fewer and fewer total chips.
So what they did, JFresh, just so this is my speculation on how they got around that, is it's not the chips themselves, it's the technology. And instead of doing CUDA core, they've switched over to contraband.
Nice.
Yeah, I mean their legal team's going to be all over any way to get around the executive order, right? It's going to be like an arms race, right?
But I mean, like, it takes years to design. It takes years to design a new chip architecture.
No, it takes 2 days. 2 days.
Yeah.
2 days is the turnaround time. You know why? It's because you've been designing chips without AI. Once you have AI improving the productivity of your workflow, 2 days. 2 days to design a completely new
there's like this
microprocessor platform.
There's like a meme in the chip world of like, most chip designers, they've got only like one chip in them before they get burned out, right? So you're like, you just got to churn through designers because it's so much effort. And yeah, the fact that they're like literally 2 or 3 weeks after the updated ban, they magically came out with a new chip architecture that just falls under the limits that were set by the ban. It's the same chip.
Yeah,
like, it's absolutely 100% the same chip.
They got fucking Jensen down in the warehouse soldering in like soldering in like an extra.
Yeah, and you think about like if it wasn't the same chip, they'd be screwed, right? And the fact that they're saying that everything is mostly fine means that it's all the same chip. Because, I mean, if it wasn't all the same chip, they would be absolutely screwed by this ban, because they were, would be ostensibly sitting on a bunch of 800 series chips that they were planning on shipping to China that they couldn't ship anymore, right? So that's an inventory issue. They've got all this stuff they paid
Which they say
TSMC
is like
for.
5.6 billion in sales.
I mean, that's a massive amount of chips that nobody else wants. No one else that can buy H100s wants a shitty version of it, right?
Mm-hmm.
I mean, that's what the A series one's for. Nobody even wants that. They all want the H100. They all want that chip. The fact that this hasn't created, a massive controversy and a huge issue for NVIDIA is because it's all the same fucking chip.
Yeah.
You see, so the contraband platform, JFresh, is so much more complicated than you know. Okay.
I wonder if
What
they
they have-
ship the BIOS flash instructions to China with the chip.
Well, so what they do, is they
Yeah.
actually installed.
Here's how to undo the nerfing that we did.
We installed a governor into your chip. Now, don't go looking for it, but it's just that gigantic resistor that was soft soldered on.
I'm just imagining just this, like, everything else is
It's just sticking off the end of the
crafted.
card and you just break it off.
Like everything else is just like beautifully, manufactured, and all the lines and everything are just looking, perfectly crisp corners, and everything's beautiful. And then there's just this big fat resistor, just like janky resistor wires.
Yeah, dude, that's what I'm saying, man. That's the contraband technology.
Oh
Yeah,
god.
Jesus.
they're totally stupid. The valuations on them, I mean, like the fact that we extrapolated growth so far ahead for a technology this new and without any sort of real proof in the pudding. Yeah, it's just a bubble, and I mean, we're just living in it.
Yeah.
I can't wait.
But that's like all of the Mag 7's earnings forever, right? Like it's a fucking already priced in. So if all of this, like if the bubble pops, it's worse than the .com bubble.
In terms of
it is actually worse.
Yeah.
In terms of imbalances, and it's actually worse.
It is definitely worse. I mean, like the thing is it's worse for the broader index, right? Like, these huge companies like Microsoft, they're probably going to get away okay because they have a lot of like things like Azure and all that. But for like all these startups and stuff, like, I mean, we could just look at Upstart, right? It's not worth $30 a share.
No.
It's worth maybe like, I think it's worth like $15, $16 a share.
They don't even use NVIDIA chips.
They don't.
They're fucking,
Exactly.
they were just like, we use machine learning to lend money.
Yeah, it's not generative, right? I think that's the key, is people are keying in on the idea of generative AI. They're just using machine learning. They're just using they're building their own correlations across their customers to gauge, what features of a customer make them likely to default, and it's better than the shitty existing version, right? That's the pitch.
Well,
Yeah.
but the broad sentiment isn't that generative AI is the Lord and the Savior as much as it is. This is a very good use case of AI, which means that all of these other use cases for AI or machine learning that have come out have a lot more merit.
Yeah,
Yeah.
it's.
I don't
Like,
know.
if
Upstart was massively overvalued long before AI, like generative AI, was a thing, right?
Well,
Yeah.
that was 2021.
Like I don't really put them in the same pool. I know some people might lean on it as like a comparable narrative, but I don't really think that's valid, right? They just do Equifax and TransUnion's job slightly better than Equifax and TransUnion, right?
I mean,
That's what I like.
they might be packaged in with some of the hot generative AI type things that people are buying, but for AI
ETF?
exposure, yeah. But nobody's like foaming at the mouth for them specifically. I don't think.
I
Yeah,
really like Upstart because
I
they
do
are so
too.
boring. Sure.
Yeah, it'll be interesting to invest in them when
Their share price is $10.
and rates really peak for real.
Yeah.
So, all right, let's get to predictions. I got a party. I gotta
Yep,
go
you do. All
razzle
right.
dazzle.
I'm gonna let you move your starting point up because otherwise it doesn't make any sense. Unless you really think we're gonna open at Delta neutral again.
No.
All right.
Wait, who won last week?
Me
Nobody.
ish.
Of course.
Nobody won.
My line was on top of all of yours, so
Oh,
Okay.
that's not a win. Come on. I say we all get zeros.
All right,
Price is
fine.
Right rules. Price is Right. Well, no, I think that would distort. Okay. Anyway, what do I want to do?
So after we test 4,000 on Tuesday,
Flat into the
flat into the end of the week.
Where else am I going to go from that?
All right. All right. Now give me a real one.
I mean, the real one, I think probably. I actually don't know how much different it'll be, other than like degree of move, because I mean the 20-year auction's we're going down for the 20-year auction, probably let's say 44.50. Then momentum will continue to 44.25 into Tuesday, and then Nvidia earnings come out, which will plummet us down to 43.50, and then that will maybe we'll get a little pumpy pump from people trying to buy the dip. So on Thursday we'll go to 43.80, and then Friday we'll go to 4,300.
Damn. All right. Dorcas.
I'm gonna say, yeah, one on Monday, but not 44.50. I say down to 44.90, and then the next day, we're gonna have an intraday test of 4,500, and then fail back down to like 44.75. Yeah, and to close. And then from there, we're going to, whew, this is tough now. Overall trend down about 40 basis points, 40 more basis points. So like, what's that? 44,
50-ish.
yeah, 44.50. We'll just call it that. And then we bounce, like Jay Fresh says, about 50 basis points or so. So that would be
Back to
44.90.
okay.
And then I don't want to play Friday bearishly, so I'm going to say flat on Friday, just 0%. I'm going to frustrate everybody right now.
All right. I'm gonna go with open at 44.90.
Ooh.
I think I agree with JFresh 44.50 by end of day. And then I kind of am a little more bearish on Tuesday. I think Tuesday, like mid or early part of the day, we could test 4,400. And then I think we bounce into the end of the day. Maybe back to like 30. And then day after NVIDIA earnings, I think pretty flat. Then maybe a test of DN, GN into the end of the week. Yeah, that's kind of where I'm at.
Look at that. We ran a gamut of bearishness now. See, one of us is moderate. The other one is really bearish.
So we're going to 4,800.
I mean, unless like something substantial changes and $300 billion of calls magically appear to the upside, I just don't see a lot of room up, right? I mean, like I think we're all in agreement on that. There's simply not the support there for more upside. And last week, you know, I did say we were going up. I didn't think we were going to go up as much as we did. But I did think we were going up in the first part of the week. I did expect us to come down into the end of the week, which didn't happen, which makes me even more bearish on tomorrow.
I mean, yeah, there's just not a lot.
Magical flat gain for 3 days after rocketing up for 3 weeks wasn't suspicious to you at all?
It was 4 days. 4 days. Also, let's talk about the diamond top. That shit's bearish as fuck. I mean, it has a high success rate on indexes because it happens so rarely. It usually happens like after market crashes. And they usually pull back really, really hard. I mean, generally markets don't gap up 2 to 3% overnight, right? But like not being able to find any additional upside and like having lower tests in the back half of it that's pretty bad, right? Like even if we look at it, if we don't look at it from like a volume perspective, and the volume did dwindle, but like if we just look at it from a price perspective, there's no buyers above futures 43.35 or 45.35 like at all, right? Every test of 43.35 has failed horribly. And that's 4 tests now over the span of a week. It's not a good look.
Yeah. We covered a lot of ground today. It was fun.
Yeah, I had a fun time. Yep, I'm going to continue drinking until tonight when I can sleep.
Yeah,
Right on,
you don't want to come down from whatever you
Nope.
did last night.
No, I can't. I cannot.
He's trying to get a soft landing, okay?
Your heart would actually stop.
I'm aiming for a soft landing. I figure my drunkenness is transitory, but it's still there.
You have to taper.
All right. Well, happy birthday, you bastard.
Thanks,
Yeah,
man. I appreciate it, guys.
All right.
I'll see you later.
See ya.
Yep, thanks. See ya.
All right, guys. Thank you so much. I'm not actually going to be doing anything fun tonight, so like I'm going to go get some dinner, but I should be around most of the day. If you have any questions that I wasn't able to get to, hit me up. Probably before I start getting drunk and doing Pickles picks would be a good idea. After that, I can't promise any clarity in my responses. So yeah. And then so I'll be around. Hit me up if you got a question. Otherwise, Pickles picks will be out tonight, probably late. I want to kind of watch futures and Asian, like some of the Asian market session, but I don't think we have too much data right now. I think for tomorrow's pretty light, so we should kind of be at the whim of the market. Let me just check this real quick. Yeah, I think we have some some China data at around 8 tonight, and then really not much besides that. Tomorrow we have like German PPI, and then we have the leading the CB leading index, and then we got some bond auctions, and we got the 20-year at 1 o'clock, which is going to be probably the most important thing happening tomorrow. And then tomorrow night we have the 20-year JGB auction, which could also be pretty important. So those will be the two focal points, I think. I don't think German PPI is going to matter that much. European construction output might matter, but it probably won't. It's already kind of shit. And it's expected to stay shit. So, but yeah, the rate decisions from China tonight are going to be important, especially when weighted against the dollar, and the 20-year bond auction tomorrow is going to be very important, especially after the 30-year whiffed so hard last time. Thank you guys so much for tuning in. And I'll see you tomorrow. Have a good one, guys.